Hello traders, Gary Wagner here. It is 12:48 in Honolulu, 5:48 in New York on Tuesday, 14th day of February 2023, and this is the Daily Report for Gold and Silver. Today, the government released its latest information on inflation vis-a-vis the CPI for last month. It came in as expected, and as far as gold goes, it was a non-event. Gold gained $1.30, and the April contract is currently fixed at $1,864.80. The dollar also remained fractionally unchanged, down 0.08%. It did have an exaggerated low, and the dollar index is currently fixed at 103.165. Lastly, silver, another non-event, down 0.01%. We're talking about a net change of under a cent, and we have the most active March contract at $21.85. Traders, before we start today's show on the all-important day of the release of the CPI numbers, the inflation numbers for last month, I'm excited about an interview we just completed with Michelle from Kitco News and David Nelson, a renowned hedge fund manager with about $3 billion under management. We will air that tomorrow, and I'm excited to share that with you. Of course, today, the CPI report came in as expected, did very little to gold. This first chart is a long-term chart of gold in Japanese average or Henkinashi format. And the reason I like this chart so much is it gives you such clarity when looking at rallies and then looking at corrections. It's almost solid red or solid green. You also get the pivot that we've talked about before, but it really clarifies, as far as I'm concerned, when a trend is growing and when it will continue. The key is this. We have had a rally beginning in November that first took us just to about 1,800. We had a 23% retracement and an exceedingly long second leg, taking us just shy of $2,000. I believe the high was $1,980. For that reason, I'm not going to be surprised if we have a much deeper correction than we have in the past. Already, we are approaching, we've gone past the 38.2, and I'm looking at gold finding support at anywhere between 1850 or 1815. Those are the 50% retracement and 61.8% Fibonacci retracement. We are still solid red. That's why I pulled up this chart first. And the reason I'm looking at a very long-term chart is to show you that this is a rally unlike any rally we have seen in gold in quite some time. We think that the best posture right now for traders is to definitely be neutral with no active trades in gold or silver. Those that are buying physical metal, I still believe that it is time to wait until we enter a long trade and then go back into an accumulation stage. All I have done, traders, is converted the Henkinashi to a standard candlestick chart. We can see that it is not as cut and dry. In other words, we had strong down days. This was last week, Monday, Tuesday, and Wednesday. Slight moves up and then back to a corrective market. I absolutely believe that when we just simply take a look at price points, it had potential tops. This one comes in roughly at about 1845. I believe that we should see a little bit more downside, but depending on the reaction of what comments come out of the Federal Reserve now that they have a strong jobs report and today's report showing a decline in inflation, it's almost a guarantee that in March, they'll raise rates again, 25 basis points, and then pause. I believe that it is at that point that they pause. And if, in fact, inflation begins to get sticky, in other words, we don't see the kinds of declines we have been witnessing, that's when we'll see gold pop. I still believe we haven't seen the high of the year yet, but that will not occur unless inflation is confirmed to be more persistent than the Federal Reserve thought it would, or they raise rates more aggressively than they are currently anticipating. Once again, my recommendation is to maintain your current neutral stance and await our next trade alert. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.